Hello, everyone, and welcome back to the Lifestyle and Financial Freedom podcast with me, Annette Ferguson. I don't know what it's like where you are, but for us here, it really does feel like winter is starting to set in. We have frost on the ground, it is getting pretty chilly. So I hope that you are staying warm wherever you happen to be. Now, today, we are speaking about understanding advanced financial metrics to optimize performance. We often hear about basic metrics like profit margins and cash flow, and they are absolutely metrics that need to be tracked, measured, and understood. And we have a podcast episode already on that, and I will put a link to that in the show notes. But today we are going beyond the basics and discussing metrics that can drive sustainable growth for your small business. Whether you're a seasoned entrepreneur or just starting out, mastering these metrics will set you on a path to success. So grab a notebook because we are about to get into the details. Let's kick off by discussing why advanced financial metrics matter. That is a mouthful. As a business owner, you might be tracking your revenue and profit margins, which is great and absolutely necessary, but that is just the beginning. Metrics like EBITDA, operating leverage, and return on capital employed provide a deeper understanding of your business's health. They go beyond the basics to help you optimize efficiently, identify potential risks, and make strategic decisions. By understanding these advanced metrics, you're not just looking at the past, you're using them to plan a more profitable future. So let's start with EBITDA. You might have heard that discussed in various circles. It stands for earnings before interest, taxes, depreciation, and amortization. Think of EBITDA as a way to measure your business's operational performance. So unlike net profit, EBITDA strips out expenses that aren't directly related to your core operations. So why is this metric important? Because ultimately it helps you evaluate the profitability of your business without the noise of financing and accounting decisions. If your EBITDA is growing, it's a sign that your core business is getting stronger. Now let's talk about operating leverage. This metric shows how sensitive your profits are to changes in sales. Essentially, it measures the impact of fixed costs in your business. If you have high operating leverage, a small increase in sales can result in a significant increase in profits, but beware. It also means that a drop in sales can really hurt your bottom line. The key is to find the right balance between fixed and variable costs to optimize your profitability. Now let's explore economic value added, EVA. EVA is all about measuring the true value your business is creating beyond the cost of capital. It is a powerful tool for assessing whether your business is generating real economic profit. To calculate EVA, you subtract your capital costs from your net operating profit after tax. No PAT. If the result is positive, it means your business is adding value. And if it is negative, it signals you need to reassess your strategy. And then there is the cash conversion cycle. This metric tells how quickly your business can convert its investments in inventory and receivables into cash. And it's critical in measuring liquidity of your business. A short cash conversion cycle means more cash is freed up to reinvest in the business. To optimize your cash conversion cycle, focus on reducing inventory days if you have inventory, speeding up receivables, and potentially delaying payables and making use of payment terms. And lastly, let's talk about return on capital employed and Z-Score. Return on capital employed measures how efficiently you're using your capital to generate profits. It's especially useful if you're looking to scale your business. On the other hand, the Z-Score is a predictor of financial distress. it uses a combination of metrics to gauge your business's financial health. A score above 2.99 indicates a low risk of bankruptcy, while anything below 1.81 is a warning sign. So ideally, we want that score to be above 2.99. That is great. If we get down to 1.81, we do have a problem. So that can be a key one to track and measure in your business. So that wraps up our episode for today. Make sure that you download our strategic financial metrics toolkit, which is in the show notes to help support you calculating all of these metrics. And I hope you found the insights into advanced financial metrics valuable today. Remember, understanding these is not just about survival, it's about thriving in a competitive marketplace. And that's what ultimately we want our businesses to achieve. So like I said, make sure that you download our strategic financial metrics toolkit. It is packed with templates, checklists, and guides to help you optimize your business. Thank you so much once again for tuning in to the podcast. Please do not forget to subscribe if you enjoyed today. I would also be honored if you would leave us a review wherever you happen to be listening. And I will look forward to speaking to you all again very, very soon. Take care, everyone.